we're going to talk a little bit about sequence of returns risk. SORR. If you're not familiar with this term, you need to be, particularly if you're getting anywhere near retiring. Okay. Sequence of returns risk is the risk that despite having adequate average returns from your portfolio to support your retirement spending, you run out of money because the poor returns came first. That's what sequence of returns risk is. You had a bad sequence. You had the bad returns first before the good returns came. Because when your portfolio is falling in value and you're withdrawing substantial sums from it, it makes it more likely that you run out of money. Okay, now obviously there are other ways to run out of money. If you don't manage your money, you're going to run out of money. If you don't save much for retirement, you're probably running out of money in retirement. And, if you have some massive, huge, unexpected expenses, like you decided you're not going to buy health insurance and you had a cancer or some terrible trauma you landed in the ICU for, maybe you run out of money. Or some, long-term care situation you weren't prepared for, maybe you run out of money. But for the most part, if you've done a good job saving for retirement, you do a good job managing your money, the risk to worry about is this sequence of returns risk. To have crummy returns in the first 1, 2, 3, 5 years of retirement. The worry is that you're retiring into the next Great Depression, that you're retiring into the stagflation of the 1970s. And so that is something that you probably ought to have a plan for as part of your written financial plan. So let's talk about what those plans might look like. Okay. First of all, one plan that works for lots and lots and lots of white coat investors, it's almost a default plan, an error plan, is to just be rich. Okay. If you're very wealthy, if you retire very wealthy, sequence of returns risk just doesn't exist for you. Okay. Let me give you an example. Let's say we got a retired couple. They spend $200,000 a year. And because they did such a great job earning and saving and investing throughout their career, they retired with 10 million bucks. Okay. So $200,000 a year of 10 million is 2%. Okay. If you're only spending 1 or 2 or 3% of your portfolio a year, you're basically bulletproof from sequence of returns risk. Okay. The entire world has to melt down for you to run out of money. Okay. This is not the people who really have serious sequence of returns risk, right? If you're perfectly comfortable spending 1% of your portfolio, you're going to be fine. I mean, the truth is, on average, if you look at the data used when they're putting together things like the 4% guideline, they note that on average, when people spend 4% of their portfolio, adjusted upward with inflation each year as they go along, after 30 years, on average, they have 2.7 times what they retired with, right? The sequence of returns issue, the reason why that's only 4% rule instead of the 6% rule or the 8% rule is because occasionally you get those bad returns first. Okay, so that is where it comes from. All right, another solution besides just being really wealthy, right? If you're not spending anywhere near 4% of your money, that works fine. Another method is to work late, okay, work a long time. Okay, let's say you're one of those docs that just loves it and you keep working until you're 70, 72, 75. Well, guess what? If you're still working until you're 75, your life expectancy is probably something like 8, 10, 12 years, something like that. All these studies that look at, sequence of returns risk, they're really looking at 30-year time periods. If you are only going to be retired for a decade before you die, even if you live a little longer than you expect and you make it 15 years, guess what? You're not going to run out of money. Okay. The people who really need to worry about sequence of returns risk are the early retirees, right? If you're retiring at 45, 50, 55, you might have a longer than 30-year time period, and maybe that'll result in you, spending less than 4% or doing some more of these strategies that I'm going to talk about to deal with that sequence of returns risk. But working late, or at least having the ability to go back to work and work some of those years in retirement, has a dramatic effect on how all of this works. So all of a sudden, instead of having to withdraw a whole bunch of your portfolio in a year the market is down, or a couple of year period when the market is down, you can live off some of the money you earn. and it works dramatically better. You don't run out of money. Sequence of returns risk basically goes away. Okay, here's another method. Another method is to guarantee a whole bunch of your income. Okay, now Social Security is a guaranteed income. Obviously, you got to pay attention to who stands behind the guarantee. In the case of Social Security, it's the U.S. government. But delaying your Social Security to age 70 gives you the best deal out there on an inflation-adjusted immediate annuity. Basically, you can put the highest floor possible under your guaranteed income, your guaranteed, spending, and that can really help a lot in a year when markets are down. There are other sources of guaranteed income, right? You might have a pension from a job you took. You can also buy an immediate annuity. You can go to an insurance company, you can give them $100,000, and they might give you something as high as $600 a month for that $100,000. So obviously, you can buy more of those if you want more than $600 of guaranteed spending a month. Maybe you can buy a $250,000 one on yourself, another $250,000 one on your spouse. Right now, we're talking about $3,000 a month of guaranteed income. So you combine that with your Social Security, and all of a sudden, well, that's not too bad. Even if markets are down and we got to cut back our spending a little bit, we've got all of our essential fixed expenses covered by guaranteed income. So that's a method that works very well. Here's another method that works. A big risk in sequence risk, in the sequence of returns risk, is not just that you have poor returns. It's that you have poor inflation adjusted returns or real returns. The worst time period, actually, historically, if you look at the data for US stock and bond returns, is actually the 70s. And it's not because returns were so terrible. The returns were not good by any means. The problem was inflation went way up. And so the real returns were really particularly bad. And so you can reduce that risk by having more assets in your portfolio that tend to do well in an inflationary kind of period. Now, you can buy some bonds that are indexed to inflation, like I bonds, like Treasury inflation protected securities, or TIPS, right? Those help protect you from inflation rather than having all your bonds in nominal bonds, especially long-term nominal bonds. But just having things in there like real estate and stocks also helps protect you from inflation. Okay? Sometimes people add some other stuff, commodities, or some crypto assets, or some precious metals, or things like that to help protect from inflation. That's reasonable to do with a small percentage of your portfolio. But if you think about inflation being the biggest risk you're facing, you'll design your portfolio a little bit differently to try to protect you against inflation, rather than having 60% of your retirement portfolio in long-term nominal treasuries, which may not be the best move if inflation really rears its ugly head. The main thing people do when they're worried about sequence of returns risk is they just reduce the volatility of the portfolio. They take less risk. And that's typically during the last few years before you retire, and the first 5 years or so after you retire. More bonds in your portfolio, more CDs, whatever, these fixed income investments that aren't nearly as volatile as your stocks, not nearly as volatile as your real estate. And so you can just put a little bit more money in bonds. In fact, that's often called a bond tent, right? You have a few years where you have more of your portfolio in bonds, a few years before and after your retirement date, and then you actually can get more aggressive a little bit later with your portfolio once you've gotten through that really bad sequence of returns risk time period. Another thing people will do with bonds is they will actually create a ladder of individual bonds. Typically, these are treasury bonds, and typically they're inflation protected bonds. So you're making a TIPS ladder. So you actually put whatever you want to spend for those first 5 years of retirement into TIPS, right? Let's say you're going to retire in 5 years, and you want a 5-year TIPS ladder to get you through that worst of the sequence of returns risk period. So you're buying a 5-year TIPS, you're buying a 6-year TIPS, a 7-year TIPS, 8-year TIPS, 9-year TIPS, right? You're buying these TIPS bonds so that you will have that money to spend for that year. And maybe you put your entire expected spending amount for that year in TIPS. Maybe it's $100,000 or $200,000 for each of those years, and you make your TIPS ladder for it. Well, now, even if the market tanks the day you retire and it stays down for 3, 4, 5 years, you're fine, because you don't have to touch that money. You're going to be spending the money coming out of that TIPS ladder every year. Now, obviously, if you only have a 5-year tips ladder and you have a 9-year period of terrible returns, you could still have some sequence of returns risk. But a 5-year tips ladder is going to get you through an awful lot of that. That's kind of the mindset behind some other strategies. You've heard of the bucket strategy, probably. And the idea behind that is you put 1 or 2 or 3 years worth of spending in cash, and you put, years 4 through 6 or 8 or 10 in the bonds. And after that, you invest the rest of the portfolio aggressively. And in a typical year, you replenish each of the buckets. You sell some of the bonds and move it into cash. You sell some of the stocks or real estate and move it into bonds, and you replenish the buckets. But in a bad year, you don't replenish the buckets. You allow your more risky assets to continue to grow. And you just realize, hey, that's what this bucket is for. This bucket was for sequence of returns risk. We're just going to spend from it. We won't replenish it until the good returns come back in 2 years or 3 years or 4 years or 5 years or whatever. So that's one strategy people use. People use all kinds of different withdrawal strategies, and most of them, the goal is to manage sequence of returns risk. A popular one right now is called the guardrails strategy. And there's these rules involved in the strategy. When returns are this, and you do this. When returns are this, you do that. And that helps you decide how much to take out of your portfolio, where to take it from, and kind of manage that spending to try to minimize the sequence of returns risk. But the main idea behind it is just to spend less. When the risk shows up, you go, okay, well, I got to cut back. Now, some people are surprised just how much they have to cut back their spending in those years. It's not cutting back your spending just 10%. I mean, that'll help. But you might have to reduce spending. If this is your only method of dealing with sequence of returns risk, you might have to reduce spending by 40 or 50%. And for more than a year, 1, 2, 3, 5 years, that's possible. So if your only method of sequence of return risk mitigation is reducing spending, you better be prepared to reduce spending a lot in order to make sure you don't run out of money before the end. But that's the concept of sequence of returns risk. Those are the basic ways of dealing with it. You ought to know about what that is. You ought to have a plan for it if you're getting close to retirement. You ought to put that plan into your written financial plan. Hope that's helpful to you.
The hosts of The White Coat Investor are not licensed accountants, attorneys, or financial advisors. This podcast is for your entertainment and information only. It should not be considered professional or personalized financial advice. You should consult the appropriate professional for specific advice relating to your situation.